would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to another day and another show. I appreciate you spending your valuable time with me. I hope we leave you with some interesting stuff to think about at the very least. Hopefully some great things to help guide you on your path to success, whatever that may be. We'll see how far we get. It's another one of those days where I have way more stuff stacked up than we could cram into the 30 to 40 minutes that I like to try to keep these things at, and that you seem to prefer in terms of length of show. So, want to give the folks what they want. As always, the absolute best way to get in contact with me is through the website. Simply head on over to therebelbroker.com. From there, you can click on the contacts link in the menu bar and send along any ideas, suggestions, observations, questions that you might have. Happy to check those out for you. Of course, while you're there, you'll want to click the big red button at the top of the page titled Take the Survey to Support the Show. And not just because I want you to support the show, but because by doing so, you'll also be entering yourself into the drawing for a $50 Amazon gift card. Now, we do this every month. We've given out $500, $600 so far. Congrats to the folks who've won that money, and good luck to the folks who have yet to win. But if you'd like to get your name in the hat for that drawing, simply go to the website, therebelbroker.com. Click on that big red button at the top that says Take the Survey to Support the Show, and you are in. Okay. Where should we start? Well, I guess we should start with, is this smart or is this dumb? I guess almost every day's show could have that as a segment where we just try to decide if something is smart or dumb. We were talking yesterday about whether it was smart or dumb for the credit card companies to do the linked with your mortgage thing. I think it's a good thing. It's a good product. I wouldn't suggest someone outlaw it or anything, but you need to understand the purpose that it serves. And if you're someone who can be super responsible and doesn't suddenly think you should be more freewheeling with your purchase on the credit card because 1% of what you spend or what you pay off, right? Because remember, that's actually when that number goes into the principal of your mortgage, is when you actually pay off the amount. And then you also remember that you'd have to charge $100,000 worth of stuff and pay it off just to get $1,000 into your mortgage. You see that it's not really that amazing. I would rather have you commit every month to putting $200 or $300 into the principal in addition to your mortgage payment, your regular mortgage payment. In order to get leverage on that kind of stuff. But anyway, we talked about that yesterday. I hope that was useful for you, by the way. Today, we have another thing that's getting broader approval here, and I'm just not sure this is smart. Let's talk about it and see how we feel. An article I put aside yesterday was talking about how Freddie Mac was going to bypass appraisals. And in the intervening 24 freaking hours, Freddie, of course, has also decided to do this. It allows property inspection waivers on some low loan-to-value loans. So let's explain what that means. It would basically mean someone who's coming down with a lot more than 20% in cash, or at least that would be my assumption on this. Now, I don't have any specifics on what that means, right? They've said the words loan to value, with low loan to value, but I don't know what that equals. Is it 30%? If you put 30% down, do you get no appraisal? If you put down 40%, do you get no appraisal? I wouldn't mind getting a little bit more detail on that. And remember, this is all designed to apparently try to speed up the process and save borrowers about $500 in fees. And the idea that it would reduce closing times by as many as 10 days. Now, the first thing that I would suggest is that where does this solve the problems that we face? That would be my first thing. What problem are you addressing with this change? And what are you giving up as a result of this change? Now, one thing to always keep in mind is that Fannie and Freddie are not just mitigating risk for some, privately run bank or institution. This is an organization that represents you and your interests, right? If they get hosed and they do stupid stuff, you're on the hook as the taxpayer for that money. And you were absolutely on the hook last time. I had a bizarre conversation with someone the other day that said, well, I never got any bill for that. Well, of course you did. You got the world's most amazing bill. It's a fantastic bill. It's a bill that you never get to see and that sneakily reduces the value of the money while it sits in your pocket. The money is stolen from you while it's in your pocket. The way this happened last time is we printed up billions of dollars of money that we had to use to bail out Fannie and Freddie for being stupid, right? If you want to sum up what we had to deal with last time, that's what it was. They facilitated this secondary market where you could put high-risk loans and securitize them. And all that basically means is bundle them together as a thing to invest in. And they were, and don't let anyone tell you different. They were absolutely at the center of that, of putting that stuff together. It probably wouldn't have happened without their involvement. As we could probably have an interesting argument on whether or not that's true, but for my money, it's absolutely true, because the bottom line is it was sold as this. The banks love it because Fannie and Freddie assume all the risk. They assume none of the upside and all of the downside, which, if you look at the other side of that coin, means the banks get all the upside and none of the downside. So you're left holding the bag with the downside if anything goes wrong, right? So all of these things they're talking about are aimed at what? They're aimed at facilitating buying. Now, I get people, and I'm not sure why it only happens on my YouTube page. As I've mentioned before, this show gets posted to YouTube automatically. I never did anything special to market the YouTube page. It just sort of happens. And I've gotten a surprising number of folks who listen on a regular basis on the YouTube page. And I get folks who will approach me and say, I'm seeing dramatic reductions in rent. I'm seeing dramatic reductions in prices, and homes aren't selling quickly. I had someone do that today. I can't even remember what city it was in. Was it Florida? May have been. But anyway, when I go and I type in that community, none of that data seems to make sense. When I type in that zip code or that city into places like Trulia and Zillow and other places that track this data, no, the real numbers I'm seeing show that the average price in that city are up $20,000. I see that the average rent is up $100 per month. So I get people who occasionally will tell me these things, but I don't see it in the real world data. I don't know if these folks are just in an area, a specific submarket within those communities that are just getting dramatically hit. I don't know. But the bottom line is, in general, across the country, and absolutely in my market, and absolutely in Los Angeles, and in all these other hot markets like Denver, and all these other areas that we talk about that are so bloated right now, so many of the metro areas, and I'll be honest, I have a hard time finding. We do shows where we specifically will talk about places where it's cheaper to buy a house these days. And we'll do another one probably in a couple of weeks, because that's usually the cycle it's on. But in general, that's not the case. So we're not solving the right problem for the general population, right? For the vast majority of folks out there in the real estate world. We are making it easier for folks to buy quicker, when what we should be solving is making it easier for builders to build quicker and cheaper, so that if we make it cost them less, if the cost of conforming with different regulations goes down, then the price they charge us goes down. That's the way it tends to work, particularly when these folks start competing with one another. If you have two developers building in a larger community and they're both building single-family residential homes, there's going to be a competition between those two. And if you were reducing the regulatory costs, you're guaranteed that the folks who are going to be doing the buying are going to get a better deal. Okay. So first of all, this particular gun or solution is aimed at the wrong problem, because the problem it's trying to solve does not exist for the vast majority of people out there in the market. Now, for those of you who are in markets where prices are down and there's not enough buyers and you try and sell your house for a year and it hasn't sold, this will help you. But for the other 95% of us, it doesn't. And then there's also the impact, right? Whenever you're going to make a decision like this, the next thing to think about is, what's the risk reward, right? Let's assume this is a good thing to do. Let's assume the goal of making escrows close faster makes a whole lot of sense. Let's assume there's some huge burden relating to that. There isn't. I'm not seeing a cry from the universe that we need to shorten the number of days it takes to close an escrow. 30 days is pretty typical. 30 days is what I've been able to swing. I was up to 45 days for a while when we had really weird stuff going on with different, particularly with VA loans. VA loans tend to take a little longer, but typically that 30 days is totally adequate. So I'm just not real sure what problem we're solving. And typically 30 days is the amount of time people need anyway. You go into, if you're someone who rents and you're going to go into escrow, well, you need to give 30 days notice when you're going to leave your rental. If you're a seller and you're selling, well, you'd like 30 days to be able to schedule the moving trucks and put everything together and get everything arranged. So I just, are there folks who would benefit from a 10-day close? Absolutely. Is it something that would work for the majority of folks? Usually not. Usually from a stress standpoint, that 10-day close is not an optimal thing. Of course, it's great if you've got a vacant property, those kinds of things that can often work great for the seller. If you're talking about someone who is already in escrow on a house that they're selling and they want to buy this one to move into it as their next residence, sure, in that situation, that absolutely works. But even then, we're not talking about things that make or break the market here, right? But let's talk about something that does make or break the market. We spent how many years screaming? This is what blows me away, because the same boneheads that are talking about this kind of thing were screaming this crap 6 years ago, 7 years ago, 10 years ago, right? When we were at the peak of the bad, in 2006, 2007, 2008, and in the years intervening, right? The next 2 to 3 years after that, one of the favorite scapegoats, in fact, one of the industries that suddenly needed so much more attention and needed so much more accuracy in what they do was what? It was appraisers. Appraisers were huge sinners. They were one of the folks we wanted to blame. No one wanted to actually blame who actually caused this mess, but appraisers were suddenly a huge problem. So we created all these new regulations relating to appraisers, which completely screwed over getting appraisals done, by the way. It was a good year we were struggling with the stupidity of the new appraisal rules, where banks couldn't talk directly to appraisers. And we, frankly, created what is really a bad for appraisers circumstance that adds no value. There was no, and don't be misled, there was no value add in any of the regulations that were added to the appraisal industry after the downturn. You gained nothing in terms of any guarantees that your appraisal was somehow more accurate or better. So yeah, that's one you can take to the bank. You could Google that and find out what the differences are, but it's nothing. It means absolutely zero, and helped you not at all, and created a middleman in that process that we simply don't need, and really screwed appraisers. Every appraiser in the country got a pay cut as a result of those regulations that they shouldn't have gotten. But anyway, so this part of the real estate equation that was so important that we needed to pass brand new regulations to guarantee their authenticity and to make sure there was no weird stuff going on. Here we are, 7, 8, 9, 10 years later, right? Because there was years that they were pissing and moaning about the appraisal industry. Suddenly, we don't even need one of these. Oh, we don't need to worry about an appraisal if they're buying it at this level. What's the point? Well, there's a good point. By simply not ever even looking at the property. Because that's what we're basically saying. We're saying that an organization that never actually even goes out and physically verifies that a structure is on that property is going to loan potentially hundreds of thousands of dollars simply because the loan to value ratio on paper is looking good. Does anyone see a potential for problems there? Now, my first problem, and I apologize for this, maybe my estimation of the human condition is not high enough. Maybe I need to take a more angelic approach. But nothing screams potential for fraud than, well, let's see, this home was listed for $200,000. This person's going to pay $200,000 cash, or not $200,000, right? If it was cash, then Fannie wouldn't be involved. But he's going to pay 75% in cash. So we'll go ahead and give him the $25,000. Well, what the hell does that even mean? What if it's an empty lot that's only worth $20,000, right? And I'm assuming that there'll be some sort of filters to catch that egregious level of horrible, but maybe not. So on that basis, on the invitation of fraud, I think we have a problem. But then there's the fundamental question of, can we live without appraisals? Now, we're going to go ahead and talk about that a little bit more. We're going to take a quick break. We'll be right back, so don't go away. We're going to cover that in a second.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Hello, everyone, and welcome back. We're talking about the interesting desire on the part of Fannie and Freddie to create circumstances under which an appraisal does not happen. And my take on it is that it's stupid. Frankly, given the amounts of money we talk about when we're acquiring property, paying $500 to have someone come out and do an assessment of the value of the property makes complete and total sense. Because you're first of all, you want that, right? In any, particularly in a process where you're fussing with someone else's money. And remember, this is your money we're fussing with. It's our money. So I'd like them to act responsibly, and I don't think there's anything irresponsible about asking a borrower to cough up $500 to cover the cost of someone to come out and verify that this home isn't about to be swallowed by a hellmouth. And, you know, as a real estate person, I can absolutely tell you that there have been circumstances where I have gone and visited a property that was surrounded by $500,000 properties, $600,000 properties. But when you went inside of this house that was surrounded by the homes of that value, you discovered that there were some serious problems. Maybe giant holes in the floor, or nothing was level, or the place had been stripped of almost everything, wiring, plumbing. There were times when I saw that. So if you don't send an appraiser out, how does that work? Are they going to base it on the real estate agent's assessment of the condition of the property? Is there going to be a piece of paper at all? Does anyone take even a fundamental level of responsibility for the condition of the property? I tell you, this whole idea stinks. And I think it could potentially cause some very big problems. Now, this also somehow assumes that whatever the list price is for the house, or whatever the agreed upon sales price, is somehow reasonable. And I'll bet you that there's going to be some interesting gymnastics done with this in terms of getting creative with calculating what sales prices are in relation to how much money is being put down in order to pull the maximum amount of money out of a potential Fannie and Freddie loan. So generally, I'm not in favor of this. I don't think there is a single angle on this where the reward outweighs the risk at any level. I think it introduces a new layer of potential bad stuff that just doesn't need to exist. Having someone come out for 2 hours and look at a house and run the numbers just is so basic, so simple, so fundamental. Just a quick check. They can walk through the house. They can make sure that the water runs, the toilets flush. They can look at the property and verify a minimum level of acceptance to in some way validate that price that's being negotiated. Because the bottom line is the math you're doing is based on that list price, and if that list price is totally out of whack, there's a pretty good chance that the Fannie and Freddie folks may end up approving a loan that never should have been written at that rate. And if the real numbers had gone through, you'd discover that person wasn't really putting down as much as they should have, or that they've managed to pull out more money in terms of a loan than Fannie or Freddie ever would have loaned on that property, regardless of how much someone is putting down. So it's creepy. I think an appraisal is absolutely required. Now, here's the one caveat to this. There's been no mention of this. I need to get more details, but I'm not going to assume any level of intelligence on the part of these guys. Too much stupidity has occurred. Yeah, I'm sorry. When if one of my sons just kept hitting the same pole over and over again, I wouldn't let him drive anymore, right? Or I would at least limit his driving, or come up with some way to try to figure out how to make him better at it. I sure wouldn't just let them continue doing what they're doing and assuming everything's going to be fine. That's where we have to be with Fannie and Freddie. This is the moron on the street. This is the person who should be wearing a helmet 24/7. This is the person who we need to worry about eating crayons. That's who is in charge of Fannie and Freddie. And I know that that's a little bit extreme, but after having lived through the last downturn that so many people were concerned about, and granted, most of the experts weren't, but there were plenty of voices out there, and even just regular folks, me and a bunch of other folks, were saying this isn't the right way to do this. This is a reckless way to be handling financing. And we have them to thank for oh so much of all of that I just don't see it making sense for us to say, or allow them to say, you know what, we need to roll back some of these most fundamental and basic ways for us to assess the value of a home. Because we've done such a good job over the last couple of decades. Really, we're so knowledgeable about this that we don't think we need that stuff. Don't buy it, because you're the one who ends up paying the bill when this stuff ends up going wrong. All right, so now on the flip side, to sort of at least give them a little bit of time here in terms of what's great about this. Now, this is all going to come into effect on September 1st of 2017. Fannie and Freddie are both going to be doing this. The property inspection waivers will be allowed on mortgages with loan-to-value ratios, with low loan-to-value ratios. The government-sponsored entity explained the change will allow lenders to offer better efficiency and cost savings. And let's be clear, what we're trading this for is what they estimate to be 10 days, which sounds like bullshit. Baloney to me. Sorry. Got to keep this kid friendly. I have no idea how many people are driving their kids to school today. Just remember, you use all of these words in a sentence. What we're buying is 10 days, according to them, which is a lie. I have never had a scenario where it took an extra 10 days. Now, maybe on the processing side. When we get this stuff going and rolling, I usually see an appraisal, even with my VA loans, where it is ridiculously hard to find appraisers because they're not normal appraisers. VA appraisers are different. I think the longest amount of time that ever added to the process was 10 days. So in other words, I always gave VA loans 45 days, but that extra days was not because of the VA appraiser. It was typically because of the bizarre underwriting hoops that end up having to get jumped through. They come back asking for all kinds of weird stuff to get fixed. That's why I add 15 days to VA loans, not because of the VA appraisal, but the reaction to the VA appraisal by the underwriters. In a normal conventional loan that is not a VA scenario, I'm typically closing in about 30 days. A 30-day close is absolutely reasonable. And I usually have a appraiser out there within 4 days of us actually being in escrow doing the appraisal. And they are not the long pole. I have yet to, in the last 2 years, I have yet to have a conventional deal go through where the lender was waiting on the appraisal before they could do the next thing. It just hasn't been happening. Now, maybe it's different in other markets. I'm sure that there's variations, but I don't even think you're actually getting those 10 days. I think that's bull. Next, money. You're saving about $500. Some areas it's more. I've seen paperwork in my area where appraisals are more than that, like $550, $575. For my money, that is absolutely worth the cost to simply go out there and do a check and make sure we are dealing with the kind of property we think we're dealing with. I think is absolutely imperative and is at the minimum should be a requirement for anything where public funds are going to be at risk. And that's exactly what's happening when Fannie and Freddie are underwriting this stuff or ultimately being the holders of this stuff. This will reduce the time it takes to close a loan, making it easier for lenders and borrowers alike. Fannie explained buyers will still have the option of having an appraisal done, but will not be obligated to do it with a PIW officer. When Freddie announced its new appraisal-free mortgage, it figured it could save borrowers an estimated $500 in fees and could reduce closing times by as many as 10 days. 10 days at the outside. I would call that worst-case scenario. Fannie is not saying goodbye to the appraisal community. Explained the vast majority of purchase mortgages will still require an appraiser. Collateral underwriters uses statistical models and algorithms to built on a database of over 26 million appraisals to evaluate appraisal quality and drive greater confidence in the valuation of properties securing the loans acquired by Fannie Mae. And that's all dandy, but they're not buying a model. They're not buying a community. They are buying a single home. And we've all lived in areas where while we may have lived in a neighborhood of homes worth $500,000, $600,000, there was that one home that was crap and was not going to be worth anywhere near that. They won't benefit from that knowledge if they don't send an appraiser out to look at that property. Earlier this year, Fannie Mae updated its policy on appraisals this year and clarified its existing policy that allows an unlicensed or uncertified appraiser or an appraiser trainee to complete the property inspection. When the unlicensed or uncertified appraiser or appraiser trainee completes the property inspection, the supervisory appraiser is not required to also inspect the property. So I wanted to add that as sort of the cherry on top. So not only has Fannie Mae taken it into a policy that says we don't even need appraisals for some deals, we're going to go ahead and go with policies that allow unlicensed and uncertified appraisers and consider those good to go. So it's eating away at yet another thing that tends to work towards guaranteeing the integrity of the purchasing process, right? And by integrity, I mean its reliability. So whether we've talked about screwing with credit ratings or screwing with appraisal processes, all of these things seem to be designed to weaken the things that we need to be stronger, or weaken the things that when they were weak last time, we got hosed. So that doesn't strike me as a smart thing. However, if you're somebody who wants to buy in this way, do it after September 1st. If you're going to be paying a little bit more than the typical down payment, and you want to get a loan like this where you don't have to worry about an appraisal because you don't want the complications, maybe you're an investor and this is a property that's going to have challenges and you know it, and you don't want an appraiser coming in and causing any shenanigans with you. If you're also able to do this without getting a home inspection, and you're super confident in your abilities to estimate, or maybe you've had your own private inspection done and you know what you want to do, take this for a ride. See if it'll work for you. It might speed things up by up to 10 days, and it might save you $500. All right, folks. I hope that's been a good one to chew on today. Every time, these are all little steps, right? Someone might look at this specific thing and think, it's not such a huge deal. When you take it as a whole, all the various things that are just sort of chipping away at the integrity of the lending process and of the evaluation of the property process, it And particularly because all of this risk ends up being heaped on our backs as taxpayers, it should be very, very concerning. And not least of which the concern is this recreates the environment that we had problems in last time. So, it's mind-boggling. All right. Thanks again for listening, everybody. I truly hope that I've left you with more value on the table than the amount of time that you've invested in listening to the show. If so, you're welcome. If not, apologies. Try harder next time. Thanks for listening. I'll talk to y'all next time.